Hi and welcome back. So in the previous video we introduced the market structure, which is basically chapter 9 of our macroeconomics 1 module. So in that video we outlined the 4 different structures of the market, or 4 different market structures. We also looked at the key features of these market structures, as well as outlined the different rules that are required in equilibrium conditions of our market structure. And we made the conclusions that firms should only produce where they are able to maximize profit. And these conditions are such that if marginal revenue is greater than marginal cost, additional output should be introduced, or output should be expanded. In the case where marginal revenue is equals to marginal cost, profits are maximized. And if marginal revenue is less than marginal cost, output should be reduced. And these are the conditions of the profit maximization rule, or rather profit maximizing rule. Okay, so in this video we are going to continue this narrative. So we start our analysis of the behavior of firms by assuming that there's a perfect competition in the goods market. So if you may recall earlier, or from the earlier chapters, that a market consists of both buyers and sellers. So the buyers are demanders and sellers are suppliers. So these people, the demanders demand goods and services concerned, and the suppliers supply these goods as well. So you should also recall that competition occurs on each side of the market. In the goods market, the buyers compete to obtain the good, and the sellers compete to sell the good to the buyers. So perfect competition occurs where none of the individual market participants, which are buyers or sellers, can influence the price of the product. So the price is determined by the interaction of demand and supply, and all participants have to accept that price. So in perfectly competitive markets, all the participants are therefore price takers, meaning that they have to accept the price as given and can decide only what quantities to supply and demand at that particular price. So perfect competition will only exist if the following conditions are met. So 1, there must be a large number of buyers and sellers of the product. This means that the number must be so large that no individual buyer or seller can affect the market price. So each firm, for example, supplies only a fraction of the total market supply. So this is one of the all of these conditions are already outlined from the initial summary we had of the conditions of market structures in the first video. So the second requirement is that there must be no collusion between the sellers. This suggests that each seller must act independently without influence or colluding with other sellers. Thirdly, all goods sold in the market must be identical. So these are products suggest that this product must be homogeneous. So there should therefore be no reason for buyers to prefer the product of one seller to the other product of another seller. Also, buyers and sellers must be completely free to enter or leave the market. This condition is usually referred to as the complete freedom of entry and exit. So there must be no barriers to entry in the form of legal, financial, or technological, or even physical restrictions that inhibit the free movement of buyers or sellers. The next requirement is that of perfect knowledge. So this suggests that all the buyers and sellers must have perfect knowledge of the market conditions. So an example of this is that if one firm raises its price above the market price, it is assumed that all buyers will know that the other firms are charging a lower price, and therefore they will buy anything from the firm that they will not buy anything from the firm that is charging a higher price. So there must be no government intervention influencing buyers or sellers. This suggests that the invisible hand must be in practice without any government intervention. So the last requirement is that all the factors of production must be perfectly mobile. This suggests that labor, capital, and the other factors of production must be able to move freely from one market to the other. So as you can see that these conditions are clearly very restrictive, and it is hardly surprising that no market meets all these requirements for perfect competition in reality. However, we use the perfect market condition as a benchmark against the other market structures as a point of comparison. So in essence, perfect competition represents a clear and meaningful starting point for analyzing the determination of price and output. So how does the fact that in the perfect competition markets are price, or rather firms are price takers, impact the shape of the demand for the product of the firm? So under perfect competition, the price of the product is determined by supply and demand. That is the market interaction of supply and demand. So the fact that individual firms are price takers, or an individual firm is a price taker, suggests that firms can sell any quantity at the given market price. So this means that no firm will charge a price higher than the prevailing market price, because if they do so, they will lose all their customers, because the customers will simply go to those that are charging less. Nor will the firm gain anything from charging a price that is lower than the market price, since it can sell any unit of the output or all its units of the output at the market price. So the demand curve for the product of the firm is a horizontal line at the market price, and it can be shown in this figure. So figure A here shows the market interaction between demand and supply, or the price that is determined by the interaction of demand and supply. So graph A shows that the price of the product, which is a P1, is determined in the market by the forces of supply and demand, which is the interaction between supply and demand. While the graph B represent the demand curve faced by an individual firm under perfect competition. So this curve tells us that under perfect competition, the individual firm is faced by a demand curve that is horizontal or perfectly elastic at the existing market price. As you can see, it is horizontal to the existing market price of P1. So we call this curve the demand curve for the product of the firm. It is also sometimes called the firm's sales curve, the firm's demand curve, or the demand curve facing the firm. So the position of the individual firm is shown here by the horizontal line through corresponding with price. So the firm can sell any quantity at the prevailing market price of P1, meaning that any quantities here can be sold at the prevailing market price of P1. So at a higher price, the quantity demanded will fall to zero, since consumers will be able to purchase the product at price of P1 from other firms. And also the firm cannot charge a lower price than P1 because it can sell all its output at price P1. So the horizontal curve at P1 is the demand curve for the product of the firm, shown by this demand curve here. So this suggests that under perfect competition, the firm receives the same price for any number of units of product that it sells. It means that its marginal revenue is equals to its average revenue and are both equals to the price of the market or the market price. Okay, so since total revenue is equals to price times quantity, this suggests that under perfect competition, each additional unit sold will therefore increase total revenue by the price of the product. So this is simple to understand because as we've already established that firms are price takers, meaning that the price is fixed at the market price. The only thing that firms can do to maximize profit is to increase quantity, or rather to increase their total revenue, is to increase their quantity sold. And each additional unit that is sold will increase total revenue by the price that is given, which is the price of the product. Therefore, each additional unit sold increases the total revenue by the price of the product. And this is shown by the firm's total revenue curve that is represented by the straight line here, which suggests a positive relationship between total revenue and quantities that are sold per period, which are increasing by the slope of the price of the product, meaning that the slope is equals, the slope of this curve is equals to the price of the product. So as the quantities that are sold are increasing, because of the price, the total revenue will increase as well. So the next question to ask is, how do firms decide whether to produce and how much of a good they should produce if they want to maximize profit? So economic profit is given by the difference between total revenue and total cost. So from your total revenue, you remove your cost, you get your economic profit. And this is the economic profit, which includes normal profit. So since firms are price takers, it follows that firms can only choose output at which it will maximize its profit and not price. So they can only use output to maximize their profit and not price. So that quantity, it is where the positive difference between total revenue and total cost is at a maximum, or similarly where marginal revenue is equal to marginal cost. So this profit maximizing, or rather profit curve, shows us the fact that when marginal, it shows us the interaction between total cost curve and the total cost curve and the total revenue curve. So the total revenue, as we said, is represented by the straight line. So the total cost curve is fluctuating, as you can see. In cases where the total cost is above the marginal, the total cost is above the total revenue, there is losses in the market. So the market is running a loss, or the firm is running a loss. And in a case where this curve, which represents the total revenue, is above that of the total cost, there is a profit in the production, or rather the firm is maximizing profit. So the firm maximize profit where the positive difference between total revenue and total cost is at its maximum. So at this point here, so that is where it maximizes its profit. So in a perfect competition, profit is maximized, or losses are minimized when firms produce at an output where marginal revenue, which is equals to price, is also equals to the marginal cost, provided that marginal cost is rising and lies above the minimum average variable cost. And in the next video, we'll look at the equilibrium of the firm under perfect competition in the short run to emphasize this point. Okay, so for now, we're going to end here, and we'll continue from this point in the next video. Thank you.